Okay, let's unpack this. Today, we're diving deep into the latest financial report from DIC's sporting goods.
Yeah, specifically their Form 10Q for the
No.
quarter ending August 2nd, 2025.
Exactly. And this isn't just about, reading off numbers. We want to understand the real story behind them.
Right.
Our mission here is to pull out the most important insights from this pretty detailed document. We're looking beyond the surface, trying to figure out what's really driving their performance.
Mm-hmm.
Where are they putting their money? What do these big strategic moves actually mean for their future? And crucially for you, as someone trying to get a handle on how major retailers are adapting today.
And what's really fascinating, I think, is that a report like this, a 10Q, it isn't just dry figures for Wall Street.
Oh,
It's
really?
more like a strategic blueprint.
Yeah.
You get a window into their vision, how they're reacting to the market right now, and how they're prepping for what's next.
So we'll be looking at everything. Financial wins, this huge acquisition.
Absolutely. Financials, the big acquisition, how they're handling the economy. It paints a really rich picture of retail evolution, I think.
Okay, so let's kick things off with the big picture then. How did DICXS actually do last quarter? And year to date, up to that August 2nd cutoff, give us the headlines.
Sure. So if you look at their condensed consolidated statements of income, basically their profit and loss for the 13 weeks ending August 2nd, the headline is definitely strong growth.
Okay.
Net sales jumped 5.0%. That's up to $3.65 billion.
From $3.47 billion last year, right?
Exactly. $3.47 billion same time last year. And importantly, this wasn't just from opening new stores or something. It was mainly driven by a really solid 5.0% increase in comparable sales.
Right, comparable sales. A 5% comp increase, especially now, that feels pretty impressive. Can you remind us what comparable sales means exactly and what was actually selling well?
Yeah, good question. So comparable sales, or comps, track the performance of stores that have been open for at least a year.
Oh.
It gives you that apples-to-apples comparison, stripping out the effect of, say, a bunch of brand new stores.
Got it.
And this 5% growth, it came from two places. People spending more each time they visited, that's a 4.1% increase in transaction value, and also slightly more people coming in, a 0.9% increase in transactions.
Interesting. And the categories?
The real stars were footwear, athletic apparel, golf, and team sports. Those really hit their stride.
Okay.
They did see some slips in outdoor equipment, though. That's maybe something to keep an eye on.
Mm-hmm. And how did this translate to the bottom line, the profit?
Well, that strong top-line performance flowed through.
Right.
Net income landed at $381.4 million for the quarter.
Which is 4.71 cents per share.
Per diluted share, yeah.
Yeah.
And that's up from $362.2 million, or 4.37 per diluted share the previous year. So a decent jump.
And diluted share, just quickly, why is that the figure we usually focus on?
Right. Diluted earnings per share basically accounts for all the potential shares that could be created from things like stock options or convertible bonds.
Ah.
So it gives investors a more conservative, kind of worst-case view of earnings per share if all those potential shares came into play. It's a standard measure.
Okay, that makes sense. Now, digging into the details a bit more. This caught my eye. Other income. It saw a really significant jump this quarter. What's going on there? Is that normal?
Yeah, that definitely stands out. And it raises that important point about non-operating income stuff that isn't directly from selling sporting goods.
Right.
A huge chunk of that increase, the main driver actually, was a non-cash gain of nearly $50 million. $49.7 million to be exact.
Wow. From what?
From an investment they held in Foot Locker equity securities. Basically, they owned Foot Locker stock, and its value went up during the quarter.
Ah, so like a paper gain.
Exactly. So non-cash, because they didn't sell the stock, they just had to mark its value up on their books.
Okay.
But that gain alone added $36.8 million after tax, or about 0.45 cents per diluted share, to their net income.
So a pretty significant impact.
Huge impact. But it's a good example of how strategic investments can affect reported earnings, even if it's not cash in the bank, from operations this quarter. And maybe a bit of foreshadowing there.
Definitely foreshadowing, because that investment gain leads us right into the biggest news of the quarter, the planned acquisition of Foot Locker itself. That's a game changer.
Absolutely monumental. On May 15th, they announced the definitive agreement to buy Foot Locker.
And the price tag.
Total equity value around $2.4 billion, enterprise value closer to $2.5 billion. It's a massive move that really reshapes things for both companies.
So why Foot Locker? What's the strategic thinking there, and where does the deal stand now?
Well, zooming out, DICKC sees this as creating a truly global platform.
Mhm.
They want to reach a broader range of athletes enhance their digital side, and really solidify relationships with key brands like Nike and Adidas.
And Foot Locker brings that global reach.
Oh, yeah. Foot Locker did $8 billion in sales last year. They've got Kids Foot Locker, Champs Sports, WSS, Atmos, about 2,400 stores across 20 countries.
Wow.
So this instantly gives DICK's a huge international presence and different store formats they didn't have.
And the status sounds like it's moving fast.
Very fast. As of late August, Foot Locker shareholders had approved it. DICK's got all the regulatory green lights.
So it's happening?
Expected to close September 8th. So like any day now, basically.
Okay, a deal that big, $2.4 billion, how are they paying for it? That sounds complex. And were there immediate costs hitting this quarter's report?
It is complex. The funding's a mix. Cash they already have, borrowing from their credit lines, and potentially some new debt.
Depends on what the Foot Locker shareholders choose.
Exactly. Depends if they take cash or DICK stock. To make sure they had the funds ready, they set up a short-term bridge loan facility, initially up to $2.4 billion.
As a bridge loan.
Yeah, just temporary financing until they sort out the long-term structure. They've already reduced that facility commitment, actually, showing they're managing it actively. And they even did an exchange offer for Foot Locker's existing bonds.
Swapping Foot Locker debt for DICK's debt?
Essentially, yeah, integrating the capital structure. And over 94% of those bondholders took the offer, which is a strong sign of confidence.
Makes sense. And immediate costs.
Yes. They reported $12.5 million in pre-tax costs this quarter. Legal fees, regulatory stuff, financing fees, the usual costs associated with a big M&A deal.
Okay, lots of moving parts there. So beyond Foot Locker, what about their own stores? Are they still pushing forward with those big experiential concepts like House of Sport?
Oh, absolutely. They are not slowing down on that front at all. If anything, they're doubling down.
Really?
Yeah, the strategy is all about repositioning the portfolio towards these larger, more engaging formats. They're investing heavily in DIC's House of Sport.
How many?
Planning about 16 openings in 2025, and they're aiming for, get this, 75 to 100 of them by the end of 2027.
Wow, that's ambitious.
It is, plus about 15 DIC's Fieldhouse stores and 8 Golf Galaxy Performance Centers just this year.
Are these all brand new locations?
Interestingly, no. About two-thirds of the 2025 openings are actually relocations or major remodels of existing stores.
Upgrading their footprint.
Exactly. It lets them leverage existing market presence, but totally transform the experience. It'll increase their total square footage by 2% to 3% this year alone. It's a clear bet on the power of the in-store experience.
It really sounds like they're building destinations, not just shops, but these huge capital-intensive stores. What are we hearing about the return on investment? How do they really stand out against, just buying stuff online? And is that model truly scalable?
That's the billion-dollar question, right?
Yeah.
The 10Q doesn't give a specific ROI by store concept, unfortunately.
Shame.
But the sheer scale and pace of the investment strongly suggests they are seeing positive results from the early ones.
Okay.
The differentiation from online is that experience. You can hit balls, try on cleats on actual turf, talk to experts. It's about immersion.
Stuff you can't do on a website.
Exactly. Scalability is the challenge, for sure. It needs capital, needs the right real estate. But by doing so many relocations and remodels, they're being smarter about it, maybe more efficient than just building totally new.
So it's a calculated risk on physical retail's future.
A high-stakes bet, yeah.
Yeah.
Emphasizing that physical stores still matter, especially if they offer something special.
Right. Now, shifting gears a bit, the economy. It's, let's say, dynamic these days. How is DICS talking about navigating things like inflation and higher interest rates?
They definitely acknowledge it. The report mentions the dynamic environment, calls out elevated interest rates, inflationary pressures hitting consumers, even shifts in international trade policy.
So they see the headwinds.
They do. But they also really emphasize their strong relationships with vendors key for getting inventory and maybe better terms and their overall operational strength.
That they can handle it.
They seem confident they're well-positioned for long-term growth despite it all. And the proof's kind of in the pudding. They actually raised their full-year outlook for 2025.
Oh, really? In this climate?
Yeah. They now expect comparable sales growth between 2.0% and 3.5% for the full year, and diluted EPS between $13.50, excluding the Foot Locker costs and that investment gain.
That signals pretty strong internal confidence.
It really does.
Okay, speaking of the broader environment, let's talk policy. There was a mention of new tax legislation, the One Big Beautiful Bill Act. What is that, and how does it actually affect DICKs?
Right, the OBBBA, as it's called. signed into law July 4th, 2025. It's pretty significant for businesses.
How so?
It basically restores two big tax breaks that were phasing out from the 2017 tax law. First is 100% bonus depreciation,
Meaning?
meaning when DICK's invests in stuff like new store fixtures for those House of Sport locations or equipment or distribution centers, they can deduct the entire cost from their taxable income immediately in year one.
Instead of spreading it out over years.
Exactly. Big upfront deduction. The second piece allows immediate expensing of R&D costs, which also helps companies investing in innovation.
Okay, that sounds like a huge win for their cash flow, letting them deduct big investments right away. But I noticed the report says it won't significantly impact their annual effective tax rate for 2025. How does that work? Less tax paid, but the rate stays similar.
Yeah, that's a great catch. It highlights a quirk of tax accounting versus cash flow.
Okay.
OBBBA absolutely does reduce the cash taxes they pay now and likely in the near future. That's great for liquidity.
Right.
But the effective tax rate on their income statement, that's often based on GAAP accounting principles. In this case, taking those big deductions up front creates what's called a deferred tax liability.
Meaning they expect to pay more tax later?
Essentially, yes. Because they got the break now, the accounting assumes taxes might be higher down the road to balance it out. So the reported rate over the long term might not change much, but the immediate cash savings are very real.
Got it. Cash flow boost now, accounting catch up later.
Right.
Makes sense. One last area from the report, legal proceedings. It mentions some lawsuits. What's the story there?
Yeah, there's some shareholder class action and derivative lawsuits mentioned, filed against the company and some officers and directors.
What are the claims about?
The complaints generally allege misrepresentations or omissions about the company's business and financial health. They mention things like inventory margins and specifically inventory shrinkage, basically, retail theft.
Which is a huge issue across retail right now.
Unfortunately, yes. Now, it's important to note the company states clearly they believe the claims have no merit and they plan to fight them vigorously.
Okay.
But these things are still in the early stages, so the final outcome is unpredictable, and defending them takes time and money regardless.
Right, a complexity to manage. Okay, let's talk about the financial engine powering all this, the acquisition, the store build-outs. How's their overall financial health? What does their liquidity look like?
Yeah, you need a strong balance sheet for all this. And they seem to have one. As of August 2nd, they had $1.2 billion in cash and cash equivalents on hand.
Which is pretty healthy.
Very healthy. They state they're confident that this cash, plus the cash they generate from operations, plus their big $2.0 billion revolving credit facility.
The corporate credit card.
Exactly.
Yeah.
Which has almost all of its $2 billion, 1.98D, still available to borrow. They're confident all that is more than enough to run the business for the next year and close the Foot Locker deal.
So, plenty of financial firepower. How are they choosing to use that capital? We talked about stores, but what about shareholder returns?
Yeah, their capital allocation strategy seems pretty balanced between growth and returns. On the growth side, capital expenditures were over $500 million, $526.01 is gross, just in the first half of the year.
Mostly for the new stores and remodels.
Primarily, yes. House of Sport, Field House, that new distribution center, store remodels, they expect to spend about $1.0 billion net for the whole of fiscal 2025. Big investment in infrastructure.
And shareholder returns, buybacks.
Definitely. They bought back 1.4 million shares in the first half of the year, costing about $298.7 million.
Okay.
There's still over $200 million left on their existing 2021 buyback authorization. And significantly, they authorized a new $3.0 billion program back in March.
$3 billion. That's a big signal.
Huge signal of confidence from management in the stock's value.
And dividends. Still part of the mix.
Yep, consistent dividends. They paid out $196.1 million in the first half of the year. And just after the quarter ended, in late August, the board declared another quarterly dividend, $1.2125 per share.
So steady payouts continue.
Shows that commitment to returning value directly to shareholders, which you often see with stable, profitable companies.
Okay, one last financial point, cash flow from operations. You mentioned it was strong. Why the big increase compared to last year?
Right. Cash from ops was up almost $110 million year over year for the first 26 weeks.
What drove that?
Two main things, really. First, that OBBBA tax law timing we talked about. Yep. Getting those deductions sooner meant lower cash tax payments right now.
Okay, the tax benefit.
And second, improvements in managing their inventory and accounts payable. Basically, being more efficient with stock levels and timing payments to suppliers, that frees up cash.
better working capital management.
Exactly. Turning sales into cash more effectively.
All right. So let's try to synthesize all this. What does it really mean for you listening in, trying to understand the retail landscape? We've seen DICCs posting strong results, making this absolutely massive Foot Locker acquisition and spending heavily on these experiential stores and digital stuff,
Right.
all while handling a pretty tricky economic and regulatory backdrop.
And if you connect all those dots, it tells you a lot about where retail might be heading, or at least how a major player like DICK sees the future.
How so?
Well, they're clearly not just selling stuff anymore. They're building experiences, they're buying global reach, they're integrating tech, and it's all underpinned by some very deliberate financial planning and capital use.
Yeah.
Which brings us to, I think, a really interesting question for you to chew on. You've got DIC pursuing this dual strategy, right?
Yeah.
On one hand, buying Foot Locker with its huge network of, like, face it, often traditional mall stores,
Right.
and on the other hand, pouring billions into these giant, high-touch destination house of sport concepts.
Kind of contrasting approaches.
Exactly. So what does that tell us about the future of brick-and-mortar retail when everything's going digital? Are these big experience stores the ultimate weapon against online-only players and direct-to-consumer brands? Or is this whole thing a really high-stakes gamble on a hybrid future, where maybe the lines just blur completely, and success means mastering both distinct physical and digital games simultaneously?
A fascinating question indeed. Where does the balance lie? Something to definitely think about.